What's up, everyone? It's Sean.rampersaud here again from the Mortgage Group. Thanks for coming back to the channel. Today, I'm going to be talking to you about dollar cost averaging and what that actually means. So I'm building strategies right now, putting together an investment plan for myself. And one of the things that I'm exploring is different ways to invest in the stock market, in cryptocurrency, in different things. And one of the terms that came up is called dollar cost averaging. So I tested out dollar cost averaging, and I've started to implement dollar cost averaging into my investment strategy. What I've found is dollar cost averaging buying when you're buying cryptocurrency or buying stock is that my ups and downs are way less. I'm not a high risk person, so I don't like my stock portfolio going up and down like it has in the past. So I'm really looking for some strategies that are going to simplify things and just kind of keep things up on a slow upward curve that I'm not going to feel the major pain of loss if there's a major dip in the market. And dollar cost averaging is the strategy to use if you're looking for that stability. So, what is dollar cost averaging? Well, in simple terms, dollar cost averaging is when you buy a set amount, a set dollar value of a stock. You can buy it weekly, you can buy it bi-weekly, you can buy it monthly, but you're setting something in place. The way I have it done actually is I have a bot set in place where it automatically buys a certain amount of Bitcoin at a certain criteria level. So right now I'm setting it up where I'm buying like $100 a week worth of Bitcoin, and it's automatically coming out of my account at a set time every single week. I don't have to pay attention to the ups and downs of the market, and I'm not looking for the latest dip. Basically, what that does for me is it smooths out the ups and downs of the market. So basically, I'm not getting the major benefit of big shoot ups in the market, and I'm not feeling the pain of big shoots down in the market. Basically, what it's doing for me is I'm buying when it's up and I'm buying when it's low, but I'm constantly buying over time. And if I'm investing in something that I know or I trust or I believe will be going up over a long period of time, then this is the way to do it so that you have less risk. For me, it's huge because I have felt the pain of losing a significant amount of money in mutual funds in the past, where I put everything, eggs in one basket, and I felt the big dip, and I ended up losing $50,000 on it. So I'm using this dollar cost averaging strategy just to smooth things out. It basically has taken away all emotion out of the trading and has just made it simple for me to grow over time. So I want to use some real world examples to show you the power of dollar cost averaging. And basically, I've done two examples for you. One is going to be on the S&P 500. That's basically investing in the top 500 stocks in the United States for a long period of time. What I'm doing is a 20-year period of time for that and doing dollar cost averaging investing. So I took some screenshots of a dollar cost averaging calculator that I used online and what you would earn if you were spending a certain amount of money over time on the S&P 500. And then I did a second example with Bitcoin. And I only did 9 years for Bitcoin. Bitcoin doesn't have that long of a history, but it has significant growth. And it's expensive. So for you to go in and buy one Bitcoin right now, you're talking 80,000 bucks at this period of time. Whereas if you have done it, and that's 80,000 Canadian, if you had done it earlier on, then the Bitcoin would have been a lot cheaper. But if you did dollar cost averaging, then you wouldn't have had the spikes and the ups and downs. The S&P 500 has so far averaged out at 9.8% over the last 10 years of investing. So that's a significant gain in your capital. And the Bitcoin is even higher than that. So let's take a look at some of these examples. So the first example here is an investment that I took a look at, and it was putting in an investment of $500 per month into the S&P 500. And this is a true calculator using the actual graphs on the S&P 500. Now, basically what this $500 did for me, I put it into the account automatically every single month. Your total investment over the last 20 years would have been 126,000, and you would have taken out 523,670 out of the investment by investing in this for the last 20 years. So huge, huge, huge gains on the S&P 500, and that's at around 9.8% averaged out. So it's a great way of making your investment. In my second example, I used Bitcoin. And obviously, Bitcoin can be a little bit more risky, a little bit more volatile, but there's huge, huge growth on this. And I truly believe that this is the future of investing and where money is going. So, Bitcoin, I put $100 in per week for 9 years. And basically, my total spend that I spent on this over the last 9 years would have been around 47,000, and my return is absolutely huge. 2,618% return on investment. So the value of my Bitcoin would have been $1,277,553. That's from putting $100 a week away. $100 a week is peanuts for a lot of people. So if you can afford to do it, then investing in Bitcoin could be your greatest gain possible. So even though Bitcoin's volatile and it's dropped in value significantly during COVID and also during the Bitcoin crisis, uh, my overall losses were very little. So if you're looking for a strategy, a true and tried, tested strategy that's going to work for you, if you're looking at lower risk but lower risk type of investments, then dollar cost averaging is another way to protect yourself from the market volatility. Guys, if you like the video, please like and subscribe to the channel. It helps me get the information out to other people that need it. Like myself, I was hunting for a way to make my investments less volatile, less painful, and I really want this video to get out to people. Thanks for watching.